Hello everyone, my name is Moji. You're watching a Bitcoin Bubble news channel. The Fed is looking at the job market. It comes from the Phillips curve. It says that unemployment is down and inflation is up. There is more unemployment and less inflation. That's the Phillips curve. That's right, you can draw it. And the Fed uses it to decide what to do. Nobody likes the Phillips curve, and it's not meant as an insult to Professor Phillips. It is true that there is no evidence for it. I could give you examples of times when unemployment and inflation were low, up to the 1930s. These were times that we had in the early 1960s. It was hard to find work in the 1930s, not much growth, or even deflation. In the late 1970s, when unemployment was high and prices were also high, this was known as stagflation. So that I can show you. If you picture it as a 4-bar graph, you can fill in the blanks if you want. You could hear all 4 examples: low, high. This means there is no link. Raoul Pal, CEO of Real Vision, recently did an interview in which he talks about why we shouldn't worry about the current market trend, and instead focus on Omen key coins. Powell says that Solana has 90% of his liquid net worth. He has moved some of his capital from Ethereum to Bitcoin and doesn't hold much Bitcoin. This doesn't mean he doesn't like Bitcoin. Instead, he thinks that other assets, such as Solana, have a better chance of going up in value right now. Powell also talks about how emotionally invested people are in the cryptocurrency world. People are motivated by both fear and greed. They are afraid of losing things and are eager to get them. However, Powell supports a long-term view, similar to how Jeff Bezos keeps ownership of his stock even when the market goes down. This means that investors shouldn't get caught up in market cycles, but should instead think about how their investments will do in the long run. In other news, CoinDesk said that buyers bought Bitcoin when the price dropped on Friday after the holiday of July 4th. When traders in the US came back, they saw that Bitcoin's price had dropped more than 10%, from almost $1,610 on Wednesday to less than $1,540 early Friday. Because of this drop, buyers bought Bitcoin exchange-traded funds ETs, which led to big inflows of $43.19 million on Friday, the most in at least 2 weeks. Notably, $7.4 million in net new money came into Fidelity's Wise Origin Bitcoin Fund. Another ETF that saw net inflows was the VanEck Bitcoin ETF. The ARK21 shares Bitcoin ETF and the Bitwise Bitcoin ETF also did. You can pick any of them. There isn't any link. That means the Phillips curve can't tell you anything. It doesn't make sense because the data doesn't support it. The last time I looked at a Phillips curve, it was a straight line. In school, curves were not straight lines, but there it is. It's now even worse because unemployment is a lagging indicator, so even if you thought it was a good indicator of something, like inflation, it's actually a lagging predictor of recession. Let's say you're a business person or a boss. Of course you're an entrepreneur, but so am I. In a tough situation like when sales are down and things are moving more slowly, profits get squeezed and all that, it took a while to find, hire, and train people, so the last thing you want to do is fire them. You need to hold on to them. You take care of everything else. The lights are turned down for you. You call your landlord and try to get a lower rent. You also pay your bills slowly or drive a hard bargain on something. Other than that, you do everything to keep your profits. You only fire people when nothing else works. First, it's a sign that comes after the fact. Before you start firing people, you're already in a slump. First place. Second, you tend to do it en masse because you held on for so long. I'm not going to fire one person every month for the next 12 months. I feel like I have to hold on to all of them and then maybe fire them all at once because I have no other choice. That's why A is a lagging sign. B. Just a few months can change everything from very low unemployment to very high unemployment. There are 2 things to keep in mind if that's what the Feds are counting on, which they are because they say so. It's not a guess. First, you won't see the slump coming. It shows things after the fact, and it can go from being kind of good to bad almost overnight. As you drive this way and look out the back window, you can see that the Feds are likely to ruin the economy. But there are many other signs that tell Jim that unemployment is not a good indicator. It is not. But how do you know? What are good ways to measure? They often have a lot of complex terms. Most of the time, not many people look at them. They're not a secret, though they're there. An inverted bond yield curve is the big one, and I think people pay more attention to it. What does that really mean? In a normal yield curve, the rate goes up as the maturity date gets longer. That makes sense. I might charge interest if I lend someone money for a month, but not if I lend you money for 10 years. I want a much higher interest rate because there are a lot more risks like loss of value, credit risk, and who knows what else. In a normal yield curve, the rate goes up as the maturity date gets longer. Right now, yield curves are inverted, which means they're sloping down. This means that the rate is lower the longer the term. Why would you take a cheaper rate on a 10-year Treasury note than on an overnight loan? By the way, that's where we are now. To put it another way, this is the big money. This is the money that banks use. These are knowledgeable people. A lot of possible backers are betting that interest rates will go down a lot. If they don't, that inverted yield curve wouldn't make sense. They think that interest rates will go down because the economy is going to go into a deep slump. Now, for something a little stranger, there's something called the SOFR futures curve. SOFR is the new LIBOR, and you know what's wrong with LIBOR. But these are long-term bets on overnight rates with Treasury. This is a picture of what I think the 10-year rate will be. However, SOFR is not like that. They trade on strips, which are deals that happen every 3 or 4 years or 5 years. For some reason, the longer ones don't flow that well. In general, though, I can bet what I think the overnight rate will be in a year. Also, that bond curve is sharply upside down. Once more, this is the real person who deals so much for futures. Put another way, the big money, the banks, and the institutions. It's in the records. It's not a guess. You can check it out. It's open to everyone. It also says that rates will go down a lot in the coming months and year. Once more, these are. The bond yield curve is upside down, so you need to fix it. People with a lot of money are betting that rates will drop like a rock. That makes no sense, right? There are really only 2 reasons for this: a very bad recession and a big drop in prices. Those 2 things do go together. One more example that I don't want to talk about in the next few weeks: the Federal Reserve has a tool for overnight reverse repo. What does that mean? And the Fed says, hey, send me some cash, I'll give you a Treasury bill as collateral. You can pay it back at some point in the future. The name for this is a backward rebuild. To get money from the Fed, I can ask them to send me Treasury bills as security. I can then give them cash, and they'll pay me interest on those bills. It's a call. I don't need to do anything fancy. Okay, but the Treasury also auctions off Treasury bills, and I can bid on them, and people do. And the return on those is less than what the Fed will pay you for a phone call. So why would you bid on a sale, take a chance on the market, and get less money than you could get from a phone call? The answer is that I can't rehypothecate the Treasury bill they send me when I do the Treasury facility. This means I have to hold on to it and give it back to the Fed when they ask for it. But I can't give it to you or anyone else. On the other hand, I can take that bill if I win the sale. I can promise UBS it. Deutsche Bank can take it from UBS. Deutsche Bank can promise Barclays that it will pay. They do. But I'm bidding more strongly for that and taking a lower yield because I need the collateral. I'm not really interested in the higher yield I can get for free. That means there isn't enough collateral and banks are lowering their balance sheets and getting rid of swaps, among other things. I'm sorry to get too technical, but the point is that this is less than what you can get for a phone call when you look at 2 reversed. What they say is the same. Rates are going down, the economy is going to crash, collateral is getting harder to find, and banks are getting tighter with their money. All of those are bad signs. That quickly makes me think of another sign. It's possible for swap